In this video, traders, we're going to look at trading spike reversals. Stay tuned. Hey traders, a warm welcome to you. So one for day traders, this, right? Spike reversals. And by the way, this is a slight twist on a question I had from a subscriber, and much appreciated. One, for the subscription. Thank you very much for your support. And number two, thank you for the question. Much appreciate whether you send it in the comments or whether you send it on email. I try and get to most of them when I can, and if there's some idea that we can put out there and we can all learn from, then that's good. If it's something personal I can reply to, then I'll do that as well. So, trading spike reversals. So this question is really about the day trading strategy of, hey, we're spiking in one direction, i.e., let's just say we're spiking to the upside, and we think it's not going to continue, so we're trading on the short side here and smacking it short for a kind of retracement down. That's what I gathered from the question. Maybe if I'm interpreting wrong, you can kind of put me right on that, guys. But put me right on that, whoever sent the email in. But nevertheless, this is kind of a feasible strategy, and it's a strategy you can use on the short term. But there's some rules that I think you've got to stick to. Now, this can be quite a lucrative strategy under the right conditions, but ironically it can be the most frustrating strategy when the conditions are wrong. And there's a fine line between the two, because often if you're trying to fade these spikes, you kind of get caught out when it's just starting to move and you get frustrated. So there's a few things that you can do to at least narrow your boundaries down and give yourself the best opportunity for success here. Now, just like trading momentum on the short term, the first thing you need to do, or should do really, is to gauge what is a spike. So define a spike. So just like momentum, when you're defining, okay, what's the natural pattern of the market on the time frame I'm trading? And this is something I talked about a couple of times with videos is, hey, what's the natural rhythm, i.e. from low to high, we move 15 pips or something, then we retrace and move 15 pips. What is that? Is it 100 pips? Just getting an order of magnitude. So defining a spike, and then you want something that's maybe a little bit above that. So if the average move is kind of, I don't know, say 15 pips, let's use that as an example, you want to start fading spikes perhaps 18 pips to 25 pips, for example. Obviously you have to be more kind of digging around than that. But at that point, that then becomes a spike. So the key to that, the reason that you do that is that you're not getting caught up in what looks like spikes, but actual fact doesn't fit the criteria. And quite often, you'll see, and especially there's a trap to fall into as well. It's kind of not, I've not mentioned this, but when you're watching a really low time frame chart, often the scale resets based on action, and you can think that it's a really aggressive spike, and all of a sudden you're like, oh, it's massive, and then really it's not that much. So something being very clear on what a spike is, whether it's upside or downside, and then saying, okay, well, I consider anything above that a spike, but it's got to be less than. So it's got to be between two values. You don't want it to rip off, 50 pips. Obviously something's caused that. You want it to be more than a normal move, so that it's a little bit stretched in the eyes of most people, but not too far that perhaps it's going to cause a wave of momentum. So there's a sweet spot there. And number two is which indicators we'll use, if any. Maybe you're just trading pure price action. Maybe you want to use some overbought, oversold indicators. Maybe you want to use some, short-term moving average away from a medium term, something like that. If you're going to use them, define them and say, okay, again, similar to that, what are the readings going to be? I need to see the RSI at 80. I need to see distance between moving averages X. I need to see a tag of an upper Bollinger, whatever that may be. But defining that as well. Number three, putting each spike into context. So really this is making sure that you're looking at where it is in the big picture. Now, what you don't want to be doing is kind of fading what you perceive to be spikes when you've got an uptrend here, because that's probably not going to mean revert as much. However, if you maybe had a downtrend and you were spiking upwards, you're aligning yourself with the context of the broader market, and you've got more chance of sellers hitting it because the overall weight is pushing. Just like if you're trading momentum, it's kind of best practice to trade just one side in the direction of the longer or medium term trend. So if you're spiking up into a downtrend, you're looking for shorts. If you're spiking up into an uptrend, you leave it. You wait for a spike to the downside. So you're trading that counter trend move because it's a mean reversion trade and by the nature of it. Number 4 is being strict with stops. Like all scalping guys, you've got to be so strict with stops because one slip up, it can ruin your month. And you know, I put my hands up and say, been there, done it, scalping and just lose discipline for a moment in time. You're on the wrong end, you might lose discipline a couple of times and get away with it, and then sometimes you won't and it'll just run on and you've got like a deer in headlights and you've got to cut it and it ends up being so damaging. So being so strict, and if you need to, kind of practicing drills to do that. And number 5, defining your times of operation. I think this is the key one. You know, if you're trading a mean reversion on a short-term scalp basis, the chances of best success, or the giving yourself the best chance of success, are when the market is unlikely to continue momentum. So you are trading during lunchtime, when you are fading those spikes, when you're fading things that are in the daily range, it's chopping around, it spikes up a little bit, the flurry of volume, it fades back down. That's your edge, that's your trade. You don't want to be trading spike reversals or fading spikes at the end of the day, because likely is the supply demand imbalance is going to continue to the bell. Same in the morning. There are a little bit more opportunities in the morning at the open, but generally you've got to be, it's a different trade. It's more of a mean reversion trade on a little bit more stretch than it is a spike reversal, kind of chopping up, chopping down in a nice choppy environment that you're trading those, you know, those extensions of the spring. So, you know, having a defined time, that might be okay between whatever it may be, 12 o'clock and 2 o'clock UK time if you're trading FTSE, or 11 o'clock till 2 o'clock. You don't want to overlap into the US session, or if the US session you might be 5:30 UK time, 7:30, something like that, or whatever. But the point is fixing it. Or if you're trading FX, you might say, okay, well, I'll trade spike reversals, but I'm going to trade them overnight when the actual underlying country, so to speak, is asleep. So you're trading pound, US dollar, maybe 3 a.m. in the morning, UK time. You know, US dollar shut, London's obviously shut, Asia's open, but it's a currency pair that's not actually that much, there's not much volume coming into it in terms of native volume, if that makes sense. So the spikes in one direction may well just fizzle out and kind of drift back. But you've got to be careful that, you know, because it's such a low volume time, just the final thing on this point, guys, because it's low volume time, if you've got a lot of, if you've got someone coming in who needs something to be done, it could just run. It's quite difficult sometimes to quantify that. So just be cautious of that time. Anyway, guys, that's trading spike reversals. If you've got anything to add to that, comments in the comment section below. But as always, keep the risk managed. Good trading. I appreciate the question and the subscription support. Take care, guys. Bye-bye.